Harvard MBA, six-figure salary, IQ of 140. And yet, he just lost $50,000 on a cryptocurrency called SafeMoon. MIT engineer, designs rocket engines, can solve complex differential equations in his head, but he refinanced his house to buy Peloton stock at $150. It's now $8. Stanford PhD in economics, understands market theory better than 99% of investors. Yet she day traded her retirement account during COVID and lost 80% of her savings. What's happening here? How can people who are brilliant in their fields become catastrophically stupid when it comes to money? Charlie Munger spent decades studying this paradox. He watched Nobel Prize winners lose billions. He saw rocket scientists make elementary mistakes. He observed surgeons who could save lives, but couldn't save their portfolios. And he discovered something terrifying. Intelligence doesn't protect you from stupidity. In many cases, it makes you more vulnerable to it. Because smart people have something that makes them dangerous to themselves. The confidence that their intelligence will transfer to every domain. The belief that if they can master complex problems in their field, they can master the market. But the market isn't a math problem. It's not a logical system that rewards intelligence. It's a psychological battlefield where your greatest strengths can become your deadliest weaknesses. And the smarter you are, the more elaborate your justifications become for doing stupid things. Here's the cruel truth. Intelligence is domain-specific. Being brilliant at engineering doesn't make you brilliant at investing. Being gifted at medicine doesn't make you gifted at economics. Being talented at law doesn't make you talented at trading. But intelligent people don't know this. Their success in one complex field creates a dangerous overconfidence about their abilities in other complex fields. Psychologists call this the halo effect. Your expertise in one area creates a halo that makes you overestimate your competence in unrelated areas. And nowhere is this more dangerous than in financial markets. Consider the dot-com bubble of 1999. Some of the smartest people in Silicon Valley, engineers who built the internet, computer scientists who understood technology better than anyone, convinced themselves that this time was different. They applied their intelligence to justify the unjustifiable. They created elaborate theories about new economy metrics. Page views became more important than profits. Eyeballs became more valuable than earnings. These weren't stupid people. They were brilliant people, using their intelligence to rationalize what they wanted to believe. Munger watched this unfold with the fascination of a behavioral scientist studying mass delusion. He saw PhDs creating mathematical models to prove that companies with no revenue were worth billions. He watched venture capitalists, people who had built careers on analyzing businesses, abandon decades of experience for wishful thinking. The problem wasn't lack of intelligence. The problem was misapplied intelligence. These people took their analytical abilities, which worked perfectly in their domains of expertise, and applied them to a system they fundamentally misunderstood. Intelligence became their enemy because it gave them the tools to construct convincing narratives for irrational decisions. And here's what makes it worse. The smarter you are, the more sophisticated your self-deception becomes. Dumb people make obvious mistakes that are easy to spot and correct. Smart people make subtle mistakes that are wrapped in layers of intelligence and almost impossible to recognize until it's too late. Meet James Simons, mathematical genius, Renaissance Technologies founder. His hedge fund, Medallion, generated average annual returns of 66% for 3 decades. Quite possibly the greatest quantitative investor in history. So what happened when other mathematicians and physicists tried to copy his approach? They failed spectacularly. Long-term capital management, run by Nobel Prize winners and former Federal Reserve vice chairs, imploded so badly it nearly crashed the global financial system. Amaranth advisors, staffed with energy derivatives PhDs, lost $6 billion in a few weeks. Countless quant funds founded by brilliant academics blew up trying to beat the market with mathematical precision. What's the difference between James Simons and all the others? Simons understood that being smart doesn't make you right about markets. The failed quants believed their intelligence guaranteed success. This is overconfidence bias weaponized by intelligence. Smart people don't just think they know more, they actually do know more about most things. This accurate assessment of their general competence gets mistakenly applied to financial markets, where intelligence has little correlation with success. The result? They trade more frequently because they believe their analysis is superior. They take bigger risks because they trust their calculations. They ignore contrary evidence because they're convinced their reasoning is more sophisticated. Studies consistently show that people with higher IQs trade more and perform worse in financial markets. Doctors, lawyers, and engineers professions requiring high intelligence are among the worst investors when they manage their own money. Why? Because in their professional lives, intelligence is rewarded. The smarter diagnosis usually wins. The more complex legal argument often prevails. The more sophisticated engineering solution typically works better. But markets are different. Markets reward simplicity, patience, and emotional control qualities that have nothing to do with raw intelligence. In fact, overthinking often leads to worse outcomes. Munger understood this paradox. He said, "I'm no genius. I'm smart in spots, but I stay around those spots." He knew where his intelligence was useful and where it was dangerous. 2008. The brightest minds on Wall Street, Harvard MBAs, Wharton PhDs, former Federal Reserve officials, created financial instruments so complex that Nobel Prize-winning economists couldn't fully understand them. Collateralized debt obligations, credit default swaps, synthetic CDOs. These weren't scams created by stupid people. They were sophisticated products designed by brilliant minds who genuinely believed they had eliminated risk through mathematical innovation. And they destroyed the global economy. What went wrong? Intelligence led them to over-engineer solutions to problems that required simple approaches. They confused complexity with sophistication, mathematical precision with accuracy. Munger watched this unfold and recognized a pattern he'd seen throughout his career. Smart people have an irresistible attraction to complex solutions. Complexity feels intelligent. Simplicity feels stupid. But in financial markets, complexity is often the enemy of success. Warren Buffett, Munger's partner, built his fortune buying simple businesses he could understand. Coca-Cola, See's Candies, Geico Insurance. No derivatives, no leverage, no mathematical models. Meanwhile, brilliant quantitative analysts were creating algorithms that could process millions of data points but couldn't predict that housing prices might fall. The sophistication trap works like this. Intelligent people assume that complex problems require complex solutions. They create elaborate models, sophisticated strategies, intricate systems that feel intellectually satisfying but perform worse than simple approaches. Day trading is the perfect example. Smart people convince themselves they can develop systems to beat the market through technical analysis, algorithmic trading, pattern recognition. They build complex spreadsheets, study charts for hours, create detailed strategies. And they lose money more consistently than people who simply buy index funds and wait. The simple approach: buy diversified investments and hold them, requires no intelligence. A child could do it, but it works. The complex approach, active trading based on analysis, requires enormous intelligence. PhDs spend careers on it, but it fails. Munger's insight: markets reward the absence of stupidity, not the presence of brilliance. Avoiding dumb mistakes matters more than making smart moves. But intelligent people hate this truth because it diminishes the value of what they're good at: thinking. Meet Sarah, investment analyst at a prestigious firm, CFA charter, MBA from Chicago. She can build financial models that would impress professors. She understands valuation theory better than 99% of investors. And she hasn't bought a single stock in her personal account in 2 years. Why? Because every time she finds a company she likes, she finds more things to analyze, more metrics to calculate, more scenarios to model, more variables to consider. The analysis never ends because the analysis feels like progress. Intelligent people love the process of breaking down complex problems. It's what they're good at. It's what they've been rewarded for their entire lives. But in investing, analysis can become a substitute for action. And without action, all the analysis in the world is worthless. Munger and Buffett made some of their best investments with relatively little analysis. Coca-Cola, simple business that everyone could understand. See's Candies, profitable local brand with customer loyalty. Apple, great products that consumers loved. No complex financial models, no sophisticated valuation methods, just simple observations about businesses they could understand. Meanwhile, brilliant analysts were building elaborate DCF models to prove that Coca-Cola was overvalued at $40 per share. It's now worth over $60, plus decades of dividends. The analysis paralysis affects smart people more than others because they have the ability to see complexity where others see simplicity. They can identify dozens of variables that might matter. They can construct multiple scenarios for every possible outcome. This analytical ability becomes a curse when it prevents decision-making. Every investment can be analyzed to death. Every opportunity can be questioned until it passes. Perfect information doesn't exist in financial markets. Perfect analysis is impossible. The intelligent person who waits for certainty will wait forever. Munger's approach was different. Understand the basics. Make sure you're not doing anything stupid, then act. He preferred being approximately right to being precisely wrong. But this requires intellectual humility, the recognition that your intelligence has limitations, and intelligent people struggle with humility more than most. 2017. Bitcoin mania. Computer programmers who understood blockchain technology better than anyone convinced themselves that Bitcoin would replace all global currencies. They had the technical knowledge to understand the innovation. They could explain cryptographic hashing and distributed ledgers in detail. Their expertise was real, but their expertise made them vulnerable to a deadly cognitive trap. They found reasons to believe what they wanted to believe. This is confirmation bias, amplified by intelligence. Smart people are exceptionally good at finding evidence that supports their positions and ignoring evidence that contradicts them. The crypto enthusiasts didn't just believe, they built elaborate theories. Bitcoin wasn't just a speculative asset, it was digital gold, a hedge against inflation, the future of money. Every price increase confirmed their genius. Every criticism proved the skeptics didn't understand the technology. When Bitcoin went from $1,000 to $20,000, they felt vindicated. Their intelligence had identified an opportunity that others missed. They were early adopters of revolutionary technology. When it crashed to $3,000, they found new reasons to believe. Institutional adoption is coming. Central banks will embrace crypto. This is just a temporary setback. Intelligence provided the tools for rationalization, but not wisdom. Munger saw this throughout his career. Smart people using their analytical abilities to justify bad decisions rather than question them. The smarter the person, the more sophisticated the rationalization. During the dot-com bubble, brilliant analysts created new metrics to justify insane valuations. Price to sales became important when companies had no profits. Eyeballs and clicks became valuable when traditional metrics showed worthlessness. These weren't lies, they were intelligent reframings that allowed smart people to continue believing what they wanted to believe. Confirmation bias hits intelligent people harder because they're better at constructing convincing arguments. They can find academic papers that support their views. They can build mathematical models that prove their points. They can cite historical examples that validate their decisions. Less intelligent people might make the same mistake, but they can't defend it as eloquently. Their wrongness is obvious. Smart people's wrongness is camouflaged by their intelligence. Munger's defense against this trap was radical intellectual honesty. He said, "I never allow myself to have an opinion on anything that I don't know the other side's argument better than they do. This is almost impossible for most intelligent people because it requires using their intelligence against themselves to find the flaws in their own reasoning. John Merriweather, Vice Chairman of Salomon Brothers, legend on Wall Street. His bond trading strategies generated hundreds of millions in profits. So when he started long-term capital management with 2 Nobel Prize winners and the former Vice Chairman of the Federal Reserve, everyone assumed it would be the smartest money ever managed. They were brilliant. Their mathematical models were decades ahead of the competition. They had identified market inefficiencies that others couldn't see. And they were right. Their strategies worked. They generated consistent profits year after year. But brilliance made them dangerous to themselves. Because they were so confident in their intelligence, they used massive leverage to amplify their returns. For every dollar they managed, they borrowed $25 more. They turned small, consistent profits into enormous gains through mathematical precision and borrowed money. Until 1998, when their models failed spectacularly. Russia defaulted on its debt. Markets moved in ways their equations said were impossible. In 4 months, they lost $4.6 billion and nearly destroyed the global financial system. What happened? Intelligence convinced them that they had eliminated risk through mathematical sophistication. They believed their models were so accurate that leverage was safe. This is the leverage temptation that destroys smart people. The belief that intelligence can predict and control market movements precisely enough to justify borrowed money. Stupid people rarely get access to significant leverage. Banks don't lend large amounts to people who can't demonstrate sophisticated understanding of risk management. But smart people can build convincing presentations, create detailed models, cite academic research that persuades lenders to provide enormous amounts of borrowed money. Day traders with engineering backgrounds convince themselves they can develop systems that work consistently enough to justify margin trading. Real estate investors with MBA degrees build complex models that prove they can safely borrow 90% of property values. Crypto traders who understand blockchain technology use leverage to amplify their positions because they're certain about long-term adoption. Intelligence provides the confidence for leverage, but not the wisdom to avoid it. Munger and Buffett built their fortune without significant leverage. Not because they couldn't access borrowed money, they could have borrowed billions, but because they understood that leverage turns mistakes into disasters. Smart people hate this approach because it feels inefficient. Why not amplify good decisions? Why not use mathematics to optimize returns? Because markets are not mathematical systems. They are human systems disguised as mathematical ones. And humans are unpredictable, even when the math is perfect. Dr. Michael Burry, brilliant physician turned investor, predicted the 2008 housing crash years before it happened, made hundreds of millions betting against subprime mortgages. Genius, right? What happened next tells a different story. After his incredible success, Burry made several high-profile mistakes. He bet against Tesla too early and lost money as the stock soared. He invested heavily in GameStop before the meme stock phenomenon but sold before the massive gains. Even brilliant investors make mistakes when they step outside their circle of competence. This is the specialization curse. Intelligent people become experts in narrow domains but assume their expertise transfers broadly. Burry's genius was in analyzing mortgage securities and recognizing unsustainable trends. But his success in that specific area made him confident about other investments where his expertise was less relevant. Surgeons who save lives in operating rooms assume they can pick individual stocks. Engineers who design complex systems believe they can time the market. Lawyers who win cases think they understand cryptocurrency. Each profession rewards intelligence differently. In surgery, precision matters more than speed. In engineering, optimization is critical. In law, detail-oriented analysis wins cases. But investing rewards none of these specifically. It rewards patience, emotional control, and the ability to admit ignorance. Skills that have nothing to do with professional intelligence. Munger understood this better than almost anyone. He was trained as a lawyer but knew that legal thinking wasn't enough for investing success. So he studied psychology, economics, history, biology, anything that helped him understand how markets and humans actually work. Most intelligent people don't do this. They assume their existing knowledge is sufficient. They apply their professional decision-making frameworks to financial markets where those frameworks don't work. Doctors analyze investments like medical diagnoses, looking for specific symptoms that indicate clear outcomes. But markets aren't patients. They don't have predictable diseases with standard treatments. Engineers approach investing like design problems, optimizing variables to achieve specific results. But markets can't be engineered. They're too complex and unpredictable for optimization. Lawyers research investments like legal cases, gathering evidence to prove specific points. But markets don't care about your evidence. They move based on forces that can't be proven in advance. The curse of specialization is that intelligence in one domain creates overconfidence in all domains, and financial markets punish overconfidence more ruthlessly than almost any other field. Here's Munger's final lesson about intelligence and money. The smartest thing a smart person can do is acknowledge what they don't know. This sounds simple. It's actually almost impossible for intelligent people. Intelligence is rewarded throughout life. Smart kids get better grades. Smart students get into better colleges. Smart graduates get better jobs. Smart employees get promoted faster. By the time someone reaches financial success, they've been rewarded for their intelligence thousands of times. Of course, they believe it will work in financial markets too. But markets are different. They're not academic problems with correct answers. They're not professional challenges that reward the smartest solution. They're complex adaptive systems where intelligence often backfires and simplicity often wins. Munger's success came from understanding this paradox. He was smart enough to recognize when being smart was dangerous. He avoided investments he didn't understand, even when other smart people were making money from them. He missed the entire tech boom of the 1990s because he couldn't understand why companies with no profits should be worth billions. He was criticized for being old-fashioned and not getting it. Other investors mocked his simple approach while they made fortunes from internet stocks. Then the bubble burst. The smart money lost everything. Munger's simple approach survived and continued growing. This is the wisdom of ignorance. Knowing what you don't know protects you from the disasters that destroy people who think they know everything. Smart people struggle with this wisdom because admitting ignorance feels like admitting failure. But in investing, admitting ignorance is often the path to success. You don't need to understand every opportunity. You just need to avoid big mistakes in the areas you do understand. You don't need to be the smartest investor. You just need to be smart enough to recognize when you're being stupid. And sometimes, the smartest thing a smart person can do is absolutely nothing while others lose money trying to be brilliant. Intelligence is a superpower in most areas of life. In financial markets, it's often kryptonite. The question isn't whether you're smart enough to beat the market. The question is whether you're wise enough to know that you can't. And that wisdom, not intelligence, is what separates long-term winners from brilliant losers.